this is Ma'am Buen again for our another session of video tutorial for accounting. So let us now have the next step in our cycle, but before that, let us review what we have taken up already. So we have the first step in accounting, that is analyzation of the business transaction. So how are we going to determine if a transaction is a business transaction or not? It should affect the elements of the financial statement. And what are the elements? That is assets, liabilities, equity, revenue, expenses, and withdrawal. So after determining that it is a business transaction, the next step is recording the business transaction, and that is journalization. Remember that in accounting, if we said record, it means that we have to prepare a journal entry. So we're going to journalize the transaction. After journalization, the next step is posting to the general ledger, or the accounts, which is the scratch of a general ledger. So after posting the journal entries to the general ledger or the accounts, then after that we're going to get the balances of each account by making a footing, that is total debits and total credits, and whatever is the balance, we're going to summarize it by preparing a trial balance. So we're done up to trial balance. So after preparation of the trial balance, the next step is adjusting entry, and that is what we're going to discuss now. So for adjusting entries, we have different accounts that we need to adjust every end of accounting period. We have prepaid expense, we have accrued in unearned, then we have accrued expense, we have accrued income, we have budgets expense, or sometimes it is called as doubtful accounts expense, and we have depreciation expense. Okay, these are the 6 accounts that needs adjustment every end of accounting period. Okay, so what is prepaid expense? This is not an expense. It is not because there is a word expense, it is an expense. No, prepaid expense is actually an asset. And why is it an asset? Because prepaid expense is an expense paid in advance, or an expense already paid but not yet used or incurred. Because in accounting, we have to recognize our expense only if we have used it already or incurred it already. Again, in accounting, we're going to recognize our expense once we used it or incurred it, regardless of whether it is already paid or not. So what are the examples of prepaid expense? We have prepaid insurance, we have prepaid rent, and also office supplies. Okay, then we have unearned income. What is an unearned income? First is unearned income is a liability. It is not an income. Unearned income is an income already received, but we haven't earned it yet. Or it is an income, or it is an advance payment received from customer. So it is a liability. Why? Because we owe our customer our service. We haven't delivered yet the services and they pays us already. So unearned income is a liability. It is an advance payment received from customer, an income already received but not yet earned. Because in accounting, we recognize our income or revenue once we delivered it, once we deliver our services or merchandise. So unearned income is a liability. And we have example, we have unearned rent income, say unearned interest income. Okay, we have accrued expense. Accrued expense is a liability. Why? Because if we talk of accrued expense, it means that it is an expense already used or incurred but not yet paid. So, accrued expense is a liability. It is an expense already used or incurred but not yet paid. So, example, we have utilities payable. We have salaries payable. And we have accrued income. An accrued income is an asset because an accrued income is an income already earned but not yet received, or payment not yet received. We already render service, we already deliver the merchandise or services, but our client, our customer hasn't paid us yet. So it is an accrued income. And an example is accounts receivable, accrued rent income. Okay, and we have bad debts expense. This time, bad debts expense is really an expense, also with depreciation expense. Bad debts expense are loss incurred from non-collection of our accounts receivable. And depreciation expense, this is the expense that we incurred from the usage of our fixed asset or property, plant, and equipment. Okay, so let us discuss first prepaid expense. Again, prepaid expense is an asset. This is an asset. Okay, let us have an illustrative problem or situation. Say, on November 2, on November 1, let us have November 1, paid 15,000 for office space rental. Representing 5 months rent that starts this day. Okay, so this is our transaction. Paid 15,000 for office space rental representing 5 months rent that starts this day, November 1. So, step number 2, of course, analyzation. This is a business transaction. So, step number 2, let us prepare our entry. So, November 1, our entry, debit, prepaid rent, 15,000, and credit cash, 15,000. Okay, if this is our entry, debit, prepaid rent, and credit cash 15,000, we are using asset method. Because we have two methods used in recording our prepaid expense. One is asset method, the other one is expense method. Again, if the entry we prepared on November 1, on the date of the transaction is debit prepaid rent 15,000 and credit cash 15,000, it means that we are using asset method. Okay, so after preparation of the journal entries, the next step is we're going to post it in our T account. If this is our T account, we have prepaid rent. So we have debit 15,000. Of course, after that, after posting to our ledger, the next step is preparation of trial balance. So, when we prepare our trial balance, the prepaid rent that will appear in our trial balance is 15,000. But the question is it really 15,000? Prepaid rent, it is an advance payment. It is an asset. So, that is 5 months. Say we're going to prepare our financial statement December 31 of 2020 of the current year. So again, as of December 31, the prepaid rent that will appear in our trial balance is 15,000, which means that it is still unused or we haven't used it yet, the rent, the 5 months rent, which is wrong because we already consume of the 5 months that we paid, we already consumed 2 months, that is November and December. So, as of December 31, it is only 3 months that we are not yet, that is still an asset. We haven't used. So, we have to prepare an adjusting entry. Okay. So, again, we already recorded our asset. So, this time, we have to record our expense. So, debit, rent expense, and credit, prepaid rent. Okay, what amount we're going to record? Again, we're going to record the used portion of the 5 months. So, how many months were already used? It is 2 months, and 2 months is 6,000. So, after preparation of entry, again, you're going to post it in your T account. So, we have debit, rent expense, 6,000, and credit, prepaid rent, 6,000. So, after that, we can get the balance. This is 9,000. And our rent expense is also 6,000. So, it is correct because the remaining months that we haven't used out of 5 months is 3 months. That is equivalent to 9 months. And the 2 months that we have used it already is 6,000. And that is equivalent to 2 months. Now, what about the expense method? So, if it is expense method, the entry prepared on November 1, the same transaction, paid 15,000 for office space rental representing 5 months rent that start this day. So, if it is expense method, the entry prepared is debit, rent expense, 15,000, and credit cash, 15,000. So, after preparing the entries, we're going to post it in our T account. This is rent expense. So, 15,000. Again, on December 31, when we prepare our trial balance, the amount that we're going to get as rent expense is 15,000. But the question is, did we really use this 15,000 up to December 31? That is wrong because we only used 2 months and that is 6,000. So it means that this 15,000 is overstated. So we have to prepare an adjusting entry again on December 31. So again, we already recorded our expense. So in our adjusting entry, we're going to record our asset, which is prepaid rent and credit rent expense. So, what amount we're going to use? The asset portion, the 3 months that we haven't used it, that we haven't used yet. So, that is 9,000. So, again, we're going to post this and prepare the account for prepaid rent because we haven't have the account for that. So, debit prepaid rent, 9,000. And credit, rent expense, 9,000. So, we're going to get the balance. This is 6,000 and this one is 9,000. Okay. So, take note. Whatever method we use, whether it is asset method or expense method, by preparing an adjusting entry, at the end, they have the same amount. So, rent expense is 6,000 and prepaid rent is both 9,000. So, question, who will determine or is it us who will select or choose what method we're going to use? If it is asset method or expense method? No. We have to determine, we have to know what method we're being used because take note, this entry prepaid rent is step number 2 and we are now in step number 5. So, from the trial balance, we have to determine what method we're being used for us to know what adjusting entry we're going to prepare. Okay, let us have another one. Say, October 1. October 1, our transaction, purchase office supplies, 20,000. Okay. So, purchase office supplies, 20,000. Using asset method, say, on October 1, the entry that we prepare is debit office supplies and credit cash, 20,000. Again, if we're going to post it in at the account, we have office supplies, 20,000. So again, when we prepare our December 31 financial statement, it will appear that we still have 20,000 office supplies. But is it correct? Wrong, because out of this 20,000, we already consumed some or used some, and we have an additional information, December 31. Inventory of office supplies shows 5,000 worth of office supplies were still on hand. So again, December 31, we have an additional information. Inventory of office supplies shows 5,000 worth of office supplies were still on hand. Okay, so we have to prepare our adjusting entry. Again, what we have recorded is an asset. So this time, we're going to record expense. So we have office supplies expense and credit office supplies. Okay. So here, what amount we're going to need in our adjusting entry? It is expense. From our additional information, inventory of office supplies shows 5,000 worth of office supplies were still on hand. So out of 20,000, there's still 5,000 remaining office supplies. So how much were being used? It is 15,000. And that is our expense. So again, we're going to prepare the account for office supplies expense. Debit 15,000. And we have credit office supplies 15,000. So we have 5,000. So this one, out of 20,000, 5,000 were being left and 5,000 is an asset. And 15,000 is already expense because it is already used. Okay. So that is if it is asset method. What if it is expense method? If it is expense method, the entry prepared on October 1 is debit office supplies expense, 20,000, and credit cash, 20,000. Again, we have our office supplies expense, debit 20,000. Again, on December 31, when we prepare our financial statement, the amount that will appear in the trial balance as office supplies expense is 20,000. But again, are all those 20,000 were already used? We have an information. We still have 5,000 worth of office supplies that were still unused, and that is an asset. So we have to prepare an adjusting entry. Since we already have our expense here, for our adjusting entry, we're going to record the asset. So we have office supplies and credit office supplies expense. Again, what amount we're going to use here? that is office supplies, which is an asset. Of the 20,000, how much were still on hand, were still unused? That is 5,000. So the amount here is 5,000. Okay, so if we're going to post it in our T account, we have office supplies of 5,000, and here is 5,000 office supplies expense. So we have 15,000 expense and asset is 5,000. So it is the same. Office supplies expense is 15,000 and office supplies, the asset portion is 5,000. Okay, let us have some example here. The trial balance as at December 31 of the current year for Kolutsky Cleaners appears as follows. So we were given the trial balance. This is where we stopped last time, the last step that we have taken up. Trial balance. So this is the trial balance already. And we have our additional information. The following information is also available. Letter A. A review of insurance policy showed that 6,800 is unexpired at year end. Okay, so let us repeat it again. A review of insurance policies showed that 6,800 is unexpired at year end. Okay, so let us look at the trial balance again. So we have prepaid insurance here of 34,000. If in your trial balance, the account title is prepaid insurance, which is an asset, it means asset method were used. Okay, let us repeat it again. If in your trial balance, the account title is prepaid insurance, it means asset method were used. So for our adjusting entry, what will be our adjusting entry? So we have letter A. Okay, asset method. So it means in our adjusting entry, we're going to record our expense. So debit insurance expense and credit prepaid. So what amount we're going to use? Expense, insurance expense, because the asset were already recognized in the trial balance. So it means that we have to recognize the expense part because take note, this 34,000 is a mixed account that is partly asset and partly expense. So the asset were already recognized. So this time in your adjusting entry, what we're going to recognize is the expense part of this 34,000. How much were being expensed? So let us read again our additional information. A review of insurance policy showed that 6,800 is unexpired at year end. So if out of 34,000, 6,800 is unexpired, it means that 27,200 were already expired, which means that is the portion that were being used, and that is our expense. So that is 27,200. Okay, let us have letter B. An inventory of cleaning supplies showed 12,440 on hand. Okay, let us look for supplies, the account title for supplies. Again, the account title here is cleaning supplies, 73,740, which means if the account title is cleaning supplies, it means asset method were being used because cleaning supplies is an asset. Okay, so for our letter B, since cleaning supplies were already in our trial balance, it means for our adjusting entry, what we're going to record is the expense portion. So we have cleaning supplies expense and credit cleaning supplies. Again, what amount we're going to use here? That is cleaning supplies expense, the used portion. So how much is that? Let us have the additional information again. An inventory of cleaning supplies showed 12,440 on hand. Again, out of 73,740, there's still an inventory unused of 12,440. It means we have 61,300 cleaning supplies which are used. So we have 61,300. This portion is what we have used. Okay, let us have our next adjustment. We have unearned income. Again, unearned income is liability. It is an income already received but we haven't earned it yet. It is an advance payment received from customer. So we have unearned income. Unearned income is a liability. We have two methods used in recording our unearned income. It is either liability method or income method. So, for prepaid assets, since prepaid expenses and assets, so the method is either asset method or expense method. This time, unearned income is a liability, so the two methods is liability method and the other one is income method. Let us have a transaction. Say December 1, receive 15,000 from a lessee for 3 months rental of an equipment that starts this day. So, December 1, receive 15,000 from a lessee for 3 months rental of an equipment that starts this day. So, December 1. If our entry is debit cash, 15,000, and credit rent income, 15,000. If this is our entry, we credited rent income, it means income method were used. Why? Because we already recorded our income. So again, if we're going to post that in at the account, we have rent income, 15,000. So when we prepare our trial balance on December 31, the amount that we're going to see in our trial balance for rent income is 15,000. But again, this 15,000 is a mixed account that is partly income and partly liability. So how much of the 3 months, how much is our income? How many months were already served? There is only 1 month. It means that rent income is overstated. So we have to prepare an adjusting entry. And our adjusting entry, that is debit rent income and credit unearned rent income. Again, rent income were already recorded. So this time for our adjusting entry, the liability method will be recognized. So this is our adjusting entry, December 31. So how much will be the amount? That is the liability of this 15,000. How much is still a liability? How many months is our liability? That is 2 months, because that starts on December 1. So at the end of December 31, we only have served 1 month and we still have 2 months liabilities, and that is 10,000. So we're going to have it here. We have unearned rent income. We have 10,000. And this time, debit rent income, 10,000. So we have only 5,000 here, and we have 10,000 as rent income. Okay, that is if it is income method. Now, what about if it is liability method? So, for liability method, the same transaction. On December 1, we received 15,000. So, December 1, the entry is debit unearned rent income. And, it should be debit cash of 15,000 and credit unearned rent income 15,000. Again, if this is our T account, we have here unearned of 15,000. Again, in our trial balance, what will appear as rent income, unearned rent income is 15,000, December 31, but is it correct? Wrong. Why? Because we already earned the 1 month, the 5,000. We have served it already. So we have to prepare an adjusting entry. And our adjusting entry, December 31. Debit unearned rent income and credit rent income. This time, the amount that we use is for the rent income for 1 month because we have already served the 1 month, and that is 5,000. So again, if we're going to prepare the account for that, that is we have rent income, that is 5,000, and we have unearned of debit 5,000. So we have 10,000 unearned, and we have revenue or income of 5,000. So it is the same. So 5,000 for rent income and 10,000 for unearned for our liability. So whatever method you use, whether it is income method or liability method, just the same. We have by preparing an adjusting entry, we're going to have the same amount. Let us have another example. We have December 1. Received 25,000 from customer for services to be rendered in the future. Okay. So, if our entry, debit cash, 25,000, and credit unearned revenue, 25,000. It means liability method were being used because we record unearned revenue. And we have our additional information. December 31. We have 25% of the above transaction were already rendered. Okay. So, for our adjusting entry, since we already recognize the liability for our adjusting entry, we're going to recognize our revenue. So, debit unearned. Okay. So, what amount we're going to use? That is the service revenue. What we have earned already. And in our additional information, it says that we already rendered 25%. So, how much is 25%? So, that is 25,000 times 0.25. That is 6,250. So, 6,250. Okay. Let us have another. Let's go back to our trial bat. Again, we have our additional information. We're now in letter C. On October 1, the entity signed a contract effective immediately with Mandawi Provincial Hospital to dry clean for a fixed monthly charge of 4,000. the uniforms used by the doctors in surgery. The hospital paid for 4 months service in advance. Okay, 4,000 a month times 4 months, so that is 16,000. Again, let us look at the trial balance and look for the account titles. So we have here, we have unearned cleaning revenue 16,000. So if the account title is unearned cleaning revenues, it means that this one is unearned income and this one is a liability. So if unearned cleaning revenues were present in our trial balance, it means liability method were being used. So for our adjusting entry, letter C, since liability method were the liability portion were already recorded in our trial balance, it means what we're going to record now is the revenue. And what is the account title for revenue? That is cleaning revenues. So if we're going to record revenues, that is on the credit side. Remember, liability, revenues, and capital were credit balance account. So it is on the credit side, and automatically the debit is unearned cleaning revenues. Cleaning revenues and credit cleaning revenues. Okay, so what are we going to record? What amount we're going to use? That is cleaning revenues. Of this 4,000, of this 16,000, where is that? This one. Of this 16,000, that is for 4 months. A contract with the hospital effective, this one. So that is for 4 months, 4,000 a month, October 1. So how many months were already rendered? It is up to December 31. That is 3 months. So that is 12,000. And that means we already earned 12,000. Okay. So again, our entry, debit unearned cleaning revenues 12,000 and credit cleaning revenues 12,000. Okay. Then we have the next one is accrued income. Okay. So we have the next one, accrued income. An asset because it is already earned. We already delivered the service, but our customer hasn't paid us yet. So we have a receivable from them, and that is an asset. The best example of accrued income is accounts receivable. And also another one, we have accrued expense, which is a liability. This time, we haven't paid our expense. So an expense already used or incurred, but we haven't paid it yet. So we have a liability. For accruals, that means accrued income and accrued expense. For accruals, we prepare adjusting entry to record, in case of accrued income, to record the asset and at the same time to record the income. And for accrued expense, to record the liability and to record the expense. So unlike in prepaid expense and unearned income, wherein we have the prepaid, the asset method or expense method, liability method or income method, this time we do not have that method. I mean, again, as I have said, the reason why we prepare our adjusting entry is to record the asset and the income and the liability and the expense, because we haven't recorded it yet. Okay, so we have our illustrative situation or transaction. So additional information on December 31, service rendered but not yet billed is 5,000. So this is an accrued income. So what is our entry? That is debit accounts receivable. That is 5,000 and credit service revenue 5,000. And accrued expense, it is a liability. So our transaction unpaid utility expense at year end is 10,000. So our adjusting entry, or as I have said, why we prepare adjusting entry to record the expense because it is not yet recorded, and to record our liability because it is still unpaid. So debit utilities expense and credit accounts payable. Okay, let us go back to our problem. Let us now have letter D. A contract with a local hospital effective December 1 to dry clean their hospital linens and beddings for 5,000 a month has yet to be billed. So that was December 1. Our trial balance is December 31. So we already have 1 month service that we have rendered, and it means we already earned, but we haven't billed the hospital. So that is accrued income. And entry, letter D, debit accounts receivable and credit cleaning revenues. How much? That is 5,000 a month. Okay, again, for accrued income, take note, it says here that we haven't billed our customer. So they didn't pay us yet, and we haven't given the bill, so we don't have an entry yet. That is why we have to prepare an adjusting entry to record our receivable, the asset, and to record our revenue because we delivered the services already for 1 month. That is for the month of December. Okay, and letter E. Accrued interest on mortgage payable is 10,000. We have mortgage payable. So if we said accrued interest, it means interest expense because we have a liability, mortgage payable. So for mortgage payable, it is interest expense. If it is notes receivable, it is interest income. Okay, so we have accrued interest of 10,000. So letter E, we have interest expense 10,000 and credit interest payable 10,000. Again, why we prepare our adjusting entry? Because we haven't recorded yet the interest expense and the interest payable. It should be recorded because it was incurred in for the current year. Okay. Then we have letter F. Salaries are paid on Saturday. The weekly payroll is 25,200. Assume that October 31 falls on Thursday and the entity has a 6-day pay week. Okay. So, I'm sorry, it should be December. Sorry. This should be December. Because our trial balance is December. Salaries are paid on Saturday. The weekly payroll is 25,200. Assume that December 31 falls on Thursday and the entity has a 6-day pay week. Okay. So how many days were accrued? That is already expense or incurred, but we haven't paid it yet. So that is accrued expense. So we have to record our expense, salaries expense, and at the same time, our unpaid salary, which is salaries payable. So if our weekly pay is 25,200 and that is for 6 days divided by 6, it means our daily payroll is 4,200. And how many days are unpaid? So that is Thursday. So 2 days are unpaid. It means 4 days were being 4 days were being unpaid. That is Monday, Tuesday, Wednesday, Thursday, because December 31 falls on Thursday. So we have 4 days unpaid. So times 4. So that is 16,800. So our entry, that is for letter F. Again, salaries expense, to record our expense because it is not yet recorded. And credit salaries payable. That is 16,800. Okay, let us repeat it again. So, our weekly payroll is 25,200. 25,200, that is equivalent for 6 days. So, divided by 6, that means 4,200 is our payroll every day for a daily payroll. Times 4 days, that is the 4 days remaining for December, which is still unpaid. That is 16,800. Okay. And we have letter G. Estimated budgets for the year amounted to 10,000. For doubtful accounts expense, again, as I have said, this is a loss or expense that we incurred because we were not able to collect from our customer, from our accounts receivable. We already recorded accounts receivable, but our customer were not able to pay us. So that is an expense in our part. So, for our budget expense, we only have our entry, debit budget expense, or doubtful accounts expense, and credit allowance. And how much is that? That is 10,000. And we have letter H. Estimated depreciation on building for the year is 128,000. Again, for depreciation, this is the part of the fixed asset that were being used or consumed. So that is our depreciation expense. So we have again our entry, debit depreciation expense, and credit accumulated depreciation. How much is that? 128,000. Okay. So for budget expense and depreciation expense, the entry is always budget expense and credit allowance for budgets. Also for depreciation expense, the entry is only depreciation expense and credit accumulated depreciation, 128,000. Okay.